Hello everyone, and welcome to Fundamental Auditing, Chapter 4. So Chapter 4 is reports on audited financial statements. So here we're going to be looking at what type of reporting does the auditor do when they're finished the audit of the financial statements? What type of report and audit opinion do they provide? So there's actually different types of engagements that an auditor can provide to their audit client. So an audit client can decide to get an audit done, or to get a review done, or to get a compilation done. So there's actually different things that they can decide. So they don't need to just have an audit done. There are other options for the audit client. The doing an audit gives you the highest amount of assurance. So the highest amount of assurance that the financial statements are free of material misstatements. Okay, so that gives positive assurance. It says, in our opinion, the financial statements are free of any material misstatements. Okay, so it's the highest level of assurance that you can get, but it is also the most expensive type of report. Or type of engagement that a client can get. Okay, so usually this comes from one of the users of the audit client would like an audit to be done. So for example, the bank might say that they're not going to lend money to the company unless they have an audit done. Or an investor might not want to invest in the company unless they have an audit done, because this is just it kind of gives them confirmation or some comfort around the numbers that management's not making up these numbers. Somebody has reviewed them, looked at them, and made sure that they're not materially misstated. Audit is also the most expensive out of these three because you're doing more work, getting more evidence to make sure that the financial statements are free of material misstatement. Another engagement that a client can get if they don't want to have an audit, is a review. So they can get a review, which provides you moderate assurance, but it gives you a negative assurance. Under review, they say nothing has come to our attention that would make us think that the financial statements are not free of material misstatements. So they're basically saying that, in our review, we didn't really see anything that would come to our attention that would make us believe that financial statements are misstated materially. But it's different from an audit, because the audit, they say, in our opinion, the financial statements are free of material misstatements. In a review, you do a lot less work than an audit. So you're not going and getting specific evidence. You're basically just having discussions with the management, the audit client. You're doing some analytical procedures, like comparing last year's numbers to this year's numbers, to kind of see, is there anything that would lead us to believe that the financial statements are materially misstated? But you're not really gaining like third-party evidence. You're not looking at invoices. So you're just kind of reviewing it. So an auditor, a client might be okay with getting a review, or the bank might be okay with the client getting a review done instead of an audit, because somebody is still looking at the work. And then the last one is called a compilation. The compilation provides no assurance whatsoever. There's no attempt to verify the accuracy or completeness of the information. So what a compilation does, it basically, if the audit company, so if the auditors are going to do a compilation, they're just going to create the financial statements. So they're just going to get a whole bunch of information from the audit client, and they're going to create the financial statements from there. So basically, you're getting all sorts of receipts and invoices, and you just have to make the financial statements. So an audit firm can do a compilation, but if they do a compilation and put together the financial statements, then they can't be the auditors of those financial statements, because that's an independence threat or independence issue, because you're reviewing the self-review threat. You're reviewing your own work. Companies might get a compilation. The reason why companies would get a compilation done in order to do their tax returns. So they need a set of financial statements in order to complete their tax returns. So they might ask an audit firm to do that. So they might give them all the receipts and everything, and then just tell them to create the financial statements. So when you're a junior auditor, like I was during my co-op term, so my first co-op term, I was doing compilations first. So they some companies go straight to giving you audits. My company went and gave me I worked my way up. So I got a compilation first, where you basically just get a shoebox of all sorts of receipts, and literally a shoebox was on my desk with a whole bunch of receipts, and I had to go through them and then create financial statements from that information. So 3 levels of assurance. The client can either decide to get an audit done, a review done, or a compilation. A compilation does not attempt to verify the information. So it's not like you're looking at the receipts and saying, okay, is this a fake receipt or is this actually a proper receipt? You're not, getting third-party evidence or anything like that. You're just taking what the company gave you and creating a financial statement. If you, through your sorting of the receipts and everything, if you do find something that's very sketchy or looks fraudulent, you have to discuss that further. You can't really ignore that, but you're not looking out for it. A review, you're doing more work, so you're talking to management, you're asking questions, you're doing some analytical procedures where you're comparing last year's to this year's, doing some variance analysis, stuff like that, but you're not, you're just basically saying that, through all review, there's nothing that has come to our attention that would make us believe that the financial statements are materially misstated. But in an audit, you are saying that, in our opinion, the financial statements are fairly stated and there's no material misstatements. Okay, so 3 types of engagements a company can choose from an audit firm. We talked about this a little bit in chapter 2, but just want to go into more detail about the audit opinion. So when you do an audit, there's 2 types of opinions that the auditor is going to provide in their report. So at the end of the audit, when everything is finalized, everything is done, the auditor will provide the client with an audit report. And that audit report is what the client will give to its investors or give to its banks, the creditors, whoever wants to see that. Public companies in Canada have to get an audit done. So public companies can't just get a review done or a compilation. The rules are that they have to get an audit done. So all public companies need to get an audit done. Okay, so the unmodified opinion is the auditor is not calling attention to anything. They're basically saying in our opinion, the financial statements are free of any material misstatements. Okay, so this is a good thing. Their unmodified is a clean opinion. The financial statements are good. A modified opinion is that there's something wrong. Okay, so that there's a modification to the general audit report. Either there is something that they're not adhering to GAAP, not adhering to IFRS or ASPE rules, or they just couldn't get, there's a scope limitation, which means they couldn't get enough information in order to, they couldn't get enough evidence in order to make a conclusion on whether the financial statements are materially misstated or not. So CAS 700, CAS 705, they actually have examples of what these reports look like. So you can go into there and look at what kind of audit report is provided to these clients. So just looking more at this modified audit report. So there's two kind of ways that you can have a modified audit report. So the financial statements can have a departure from GAAP. So maybe the accounting policies are not applied correctly. Maybe there's inadequate disclosure. Maybe they're not disclosing the fact that they have a going concern, for example. So that would be a departure from GAAP. So anything that they're doing wrong, that whenever during your audit, you find something wrong or find errors that are material or close to materiality, the auditor goes to the client and tells them, they say, this is wrong. this is the right way of doing it. So do this the correct, so like do an adjustment to do this correctly. So for example, if they find, depreciation expense was calculated wrong, they'll go to the client and say, look, I found this mistake, fix the mistake. If the client fixes the mistake, then great. They can issue an unmodified opinion and say, it's free of material misstatement because they fixed their mistakes. It's only when the client refuses to fix any mistakes or any errors is when that you would have a departure from GAAP. And that's when you would have a modified opinion. So you just, the reason why they would reject fixing a mistake or fixing an error is maybe they don't believe it's actually an error. So there's, under GAAP, under IFRS and ASPE, there are some rules that could be interpreted a different way. So it could be interpreted a different way for the auditor and interpreted a different way for the auditee. So maybe they disagree on that, and if that's the case, then they'll have to provide a modified it's also called qualified. So modified or qualified are the same thing. Unqualified is unmodified, qualified is a modified opinion. And depending on how material it is, so if it's just like a little error, it's not too bad. It's like right at the borderline of materiality, and it's not gonna really affect too many decisions of the financial statement users, then they would just do a modified opinion. If it's very material and the auditor thinks that nobody should be ever relying on these financial statements to make decisions of the company, then they would issue an adverse opinion. So an adverse opinion is when the errors are material and pervasive, that if somebody relies on these financial statements, it's really going to be bad for them because they're going to make decisions on something that's absolutely unreliable. Okay, so that's so if there's just like a little mistake, you can just do a modified opinion and say everything was good except for this one thing. Okay, so if there's like a complex transaction, which is the auditor and the client don't agree on how it should be recorded, but it's not too big of a deal, then the auditor would issue a modified opinion, say, everything is good except for this one complex issue, and then they would explain what's wrong with it. If there's a lot of issues, like revenue has errors in it, inventory, cash, like there's a lot of issues going on, and the client refuses to fix any of them, then they would issue an adverse opinion. An adverse opinion is the worst opinion that a client can get. Usually, if the client gets an adverse opinion, that means the investors will pull out of the company, the banks and the lenders will not loan to the company. So it's really a bad thing that happens. And not many companies end up getting an adverse opinion because they will fix the errors that the auditor has pointed out in order to not get this adverse opinion. The other type of modified opinion is called a scope limitation. So here, it's the inability of the auditor to get sufficient audit evidence. So maybe through their work, they couldn't get the evidence that they needed to make sure that something is not materially misstated. So a popular example for this is your opening balance of inventory. So when you're auditing, let me just back up a little bit. When you're auditing financial statements, if you're auditing like the current year financial statements, for example, 2020, you're also auditing 2019's work because you have comparative financial statements. The financial statements you present has 2020 numbers and it has 2019 numbers, right? So it has your opening balances in 2020. If you've been the auditor, or somebody else has been the auditor for those 2019 numbers, then it's fine. Those have been audited before. But if this is a first-time audit, for example, then those 2019 numbers have never been audited before, and they need to be audited. But if you're doing the audit after 2020, because that's the main year, current year, you wouldn't be able to verify the inventory number. So the most popular way to verify if the inventory number is correct the year-end inventory number, is to actually go out and do an inventory count. So an auditor will go with a client, do an inventory count to make sure that what they said that they had as inventory, they actually have. Well, if the auditor got hired in 2020, they can't go back in time and do the inventory count in 2019 to make sure the opening balance of inventory is correct. So in that case, they might issue a modified opinion and say, we were able to test everything looks good, except for the opening balance of inventory we could not obtain sufficient evidence for. Okay, so because how else can you verify inventory from a year ago if you did not attend that inventory count, right? So so that could be a scope limitation saying, everything is good except for. So that would be a modified opinion. If you can't get sufficient evidence, so if the audit client can't get sufficient evidence for a lot of things, so a material amount of things, then they would have to issue a denial of opinion and state that they actually can't provide an opinion because they couldn't get the sufficient evidence. So maybe an example of that is that you're auditing the year-end numbers, but the company had like a fire in their office and all their financials, all their backup and everything got lost or got burned or got destroyed. So the auditor can't actually get the evidence that they need to. They can't pull up the invoices and get all the documentation that they need to do the audit. So they would issue a denial of opinion and say, we could not get sufficient audit evidence in order to provide an opinion on whether or not the financial statements are free of material misstatements. Okay? So if it's just a one-off thing, it's just one account, one opening balance of something, probably inventory, then they can say everything is good except for. But if there's a bunch of stuff that they couldn't obtain audit evidence for and they can't make an opinion that the financial statements are free of materially misstatements, then they would have to issue a denial of opinion. Okay, so I basically talked about this. I think I've talked about all of these points. So basically, for a modified opinion that has a gap departure, it could be isolated. So it could just be one. So it could say, the introductory paragraph, the scope paragraphs are going to be unchanged, and then they'll just say except for, and then whatever the gap departure is. An adverse opinion is a gap departure that's super material or so significant that they overshadow the financial statements. They affect numerous accounts, so they're pervasive. And you're basically saying the statements do not present fairly. So the statements are not they are materially misstated. Okay. A scope limitation, I talked about this. It could be a qualified opinion where it says except for, like everything's good except for. So it's just a reservation paragraph that's added saying everything's good except for. Or it's a denial of opinion where you say I am unable to provide an opinion. Okay. Departures from gap. If it's a departure from gap, it should be explained what the issue is. If it's a denial, then it should explain why they can't express the opinion. There's also, if you look at CAS 706, there's also some significant matter paragraphs of any additional information in those audit reports that they want to draw the user's attention to. So sometimes there's examples, sometimes there's things that the auditor would like the users to the financial statements to know. So they'll add that in as a significant matter paragraph to the end. Okay? So if there's anything else that the auditor wants the client to know, then they'll add that in. So the audit reports are pretty, there's a template. Like I said, there's a template in CAS 700 and CAS 705, but they can, add a significant matter paragraph if there is something else. So something like an accounting contingency. So for example, in ASPE, if you look at the contingency rules, or even IFRS, if you look at the rules for provisions, if there is a contingency, so there's like a lawsuit against the company, but management decides that it's not likely or not probable, or the amount can't be reasonably estimated, like if it's not if it doesn't meet the requirements in order for it to be recorded or disclosed, then they don't have to record it or disclose it under IFRS and ASPE. But maybe the auditor wants to draw this to the financial statement users, so then they talk about it. So they say there is a lawsuit against the company, but management thinks that it's not likely and the amount can't be reasonably estimated, so that hasn't been recorded, but we just want you to know. Or sometimes there's an emphasis of matter paragraph that is required. So if there is uncertainty about the going concern, so if there is a going concern issue in the company has to disclose that, but the auditor also has to disclose that. And so they also have to show that in their audit report, that there is a going concern issue. All right, so thank you for listening to chapter 4, and take care.